This is John Shealy of the Wall Street Shuffle and the Traders Country Club, and today we're going to take a quick look at gold and examine the incredible rally that we're currently seeing. Gold is now trading near 1185 as the US dollar has begun to fall against all the major currencies again. I put up an indicator that I created. I call it the JS oscillator high, and it's basically looking at a comparison of this particular run in regards to its average daily movement in regards to determining an overbought or oversold nature in regards to price action. Of course, right now we're looking at the overbought potential of gold. Now, this line that you see here, which is a value of 6, you can see gold is approaching that number. It's above 5.5 to 6. What we're going to be talking about is how you should trade it. I had mentioned on the Wall Street Shuffle about the market being overbought, and that does not mean traders should go short. By no means is that a suggestion that traders should make a counter trend position. Instead, it is a suggestion that those who are long gold should sell a portion, not all, but a portion of their long position. Now I'll explain why. When you are overbought by a technical indicator, it doesn't mean the market's going to turn immediately. Think of it like this. The market right now is at 1185. The highs of a few days ago was about 1175. That's the number, actually. 1175 was the critical level that determined whether or not we were, quote, in an overbought condition. So what does that mean? That means that sometime within the next few weeks, the gold is expected to have a correction that will bring prices back below 1,175. And let's take a look a little bit of the evidence for this. First, this indicator that I created, you do not want a market to get overbought too frequently, or it won't be effective, which is why RSI, relative strength indicator, stochastics, and other oscillators get overbought way too easily, and they therefore generate plenty of false signals. So let's just take a look in history. You can see we're going back now. We're going to take a look at 5 years. You can see it is unusual for the market to rally strongly enough to get this indicator above that value. Now here you can see we're now looking at November of 2007. Right in this zone is when the market started to, quote, get overbought. And within a few days, you never know when or where it's going to correct from, but within a few days the market started to decline. It was a correction in a bull market and should be purchased, but that's what we're talking about. It's this: once the market is overbought, imagine drawing a line straight across from that value, and that's where we would be looking for a decline below that value. Now let's go back some more, because I want to show you times of which when the indicator, see it again, many bull markets existed in which it did not get overbought. Now moving to the time period where it was less effective. I want to show you both sides. We're now in 2006. You can see in this particular case the market did get overbought, continued for another couple of days, and then had that big correction, big down move there. The same part in this time. It is overbought in this particular feature here, but it continued up $40 to $50 before it had that massive correction. So it was wise to sell into this rally as the market continued being overbought. But it was certainly challenging in regards to the expectancy of when this correction would occur. You don't know exactly when it's going to occur. However, one of the indications you want to do is if the market goes below the low of the prior day, that is our indication to begin to be more aggressive in taking profits in the position. Let's take a look at where gold is at the moment. Gold, as I mentioned, is at 1185, setting new highs. The low of today was 1166.80. If it goes below that, then we're going to suggest that traders begin to take profits from the overbought condition. If it continues higher and it goes up again on Friday, then we're going to use the low of Friday before we exit. So you're going to basically begin to trail your stop exit beginning today and over the next several days. That trailing stop is going to be the low of the prior day. This takes a little more work and study, and we'll examine this particular signal several days or weeks from now, and we'll see how it turns out. This is John Shealy of the Traders Country Club.